Hi there, and welcome to another edition of Ask Spurrell CPA. Today we're talking about Canada Small Business Financing Loans. I'm here with Cole.
Hey.
Cole, thanks for being with me. Why don't you tell everybody where you're at in the CPA pursuit?
I just wrote a midterm for my one of the prerequisites, so still working towards that.
Yeah, what was that course in?
Intermediate financial accounting.
Right on.
Yeah.
Okay. So the quote I have for you today is Robert Kiyosaki, author of Rich Dad, Poor Dad. And he said, good debt is a powerful tool, but bad debt can kill you. So he's pretty much not on the fence on that quote at all. So the statistic that we have is 23% of entrepreneurs who fail list running out of cash as the one of the concerns, which makes it the second most common reason for failed entrepreneurs to list going out of business. And the story that we have is, business owners, they come into us and they're running out of cash. They need cash for operations. But when you look back previous in the business, they didn't finance some of the hard assets that are a little easier to get financing on. So when it comes to that Canada Small Business Financing Program, Cole, what do you think are the questions that these business owners should be asking?
What does CSBFP stand for, and who can qualify for these loans?
So CSBFP, a little bit of a mouthful, Canada Small Business Financing Program. And these are loans under that program. Who can qualify for these loans are small businesses, and the program defines the small businesses as companies that have less than $10 million in revenue. So that's kind of the threshold. So it's a real wide angle. So right from startup to $9,999,000, this program is available for business owners. It's not often, most people don't often know about it, but it's available.
What is the advantage of CSBFP loans from the bank's perspective?
So the main benefit from the bank's perspective is the federal government is effectively guaranteeing the loan. So the bank knows that they're really never going to default on this loan, which is fantastic if you're a bank.
Yeah.
So they are backed by the federal government. So businesses who otherwise might not qualify might qualify for a loan under the Canada Small Business Financing Program. So if it's a little bit of a riskier project, or you don't have as much history in the business, business might qualify for a CSBFP loan, but not qualify for a conventional commercial loan.
Okay. What is the main disadvantage of CSBFP loans from the bank's perspective?
So the main disadvantage is the paperwork.
Oh.
So the bank has to coordinate with the federal government.
Oh.
So the bank can't set their own policy. They have to dot all the I's and cross all the T's and coordinate with the federal government to make sure that they're going to agree with this loan and they're going to back the loan in the event of a default. So sometimes the banks aren't, it goes outside of their regular processes. It's going to take them a little more time to qualify the loan and process the loan. So it's not all sunshine and roses for the banks from the bank's perspective. On one hand, they get it guaranteed by the federal government. On the other hand, they're going to spend a lot more time and money getting this loan approved by the federal government.
What type of banks are more likely to lend under the program?
It's been my experience that the small credit unions and the smaller banks are more likely to lend under the program. So here in Alberta, we're talking about ATB and Service Credit Union, or even some of the smaller credit unions. That being said, every once in a while there's a big bank who will lend on it, but it's not uncommon for the big bank to say they're going to lend on it and have such bad terms that you wouldn't lend on it. For example, they're going to say, yeah, we'll do a Canada Small Business Financing loan, but we're only going to lend 50% of the asset value, which most people, they're putting up a $200,000 piece of equipment. They don't have $100,000 lying around. That's why they're going for a loan. Yeah. So, generally the smaller credit unions, or even smaller credit unions are the way to go if you're trying to access this program.
What items can be financed under the program and what cannot be financed?
So it's hard assets generally. So we're talking about equipment and leasehold improvements and real estate, and that's real estate that's used in an active business, not rental properties or items like that. So it's you're not going to be lending to build your website or to finance the payroll costs or to do some advertising. That's not going to be approved under this loan. It's kind of unfortunate because the U.S. Equivalent to this loan actually does give gives them freedom for a little bit more. But in Canada, it's hard assets. So we're looking at I need a new truck, I need a new a saw, or I need to build out my leasehold improvements for my new location. That's going to be financed, but soft assets, operating capital is not.
Okay. What is the maximum amount that can be financed for equipment and leaseholds?
So the equipment and leaseholds are capped at $350,000. So any combination of equipment and leaseholds up to $350,000. So you could have $100,000 in equipments and $250,000 in leaseholds. That's available for financing if you're approved. But that's the cap on those types of assets.
Okay. What's the maximum amount that can be financed for real estate?
So real estate has a separate cap, and it's up to $1 million. So if we're talking about acquiring a piece of real estate, a shop or a storefront that's going to be used, an office, commercial space, used in an active business, the total loan can be up to $1 million. So that'll be the total loan. So if you had some equipment of $100,000, they'd lend $900,000 on the real estate. So two different limits, one for equipment, one for real estate, and the $1 million limit is a hard limit for any combination of that as well. So,
got it. What interest and loan application fees are charged to these loans?
So the interest is unlike conventional loans, where the bank's going to look at how creditworthy you are and how much they want to take a risk on you. Where then they set the interest rate. The Canada Small Business Financing loans, they're a set rate. The banks can't choose, what rate to charge you. So it's prime plus 3% rate now is the rate. So we're talking in a prime interest that, today at 3.95 plus 3%, we're talking 6.95%. So it's not a low interest rate. It's usually kind of middle of the road type of interest rate. It's not towards the higher end of some commercial loans, but it's certainly not towards the lower end either. 6.95%, and that floats with prime. If prime goes up, that loan goes up. If prime goes down, that loan goes down. The financing fee is 2%. So that's a one-time fee. You borrow $100,000 the first year, it's a $2,000 financing fee on top of the regular interest rate. But that's just in year one. It's to help to mitigate some of the costs of actually processing this loan, which is a little bit onerous to get it processed.
If the government is backing the loan, what's the risk for the entrepreneur?
So the risk for the entrepreneur is the bank can still request security on it. So it used to be, going back a few years, that the bank was actually limited in the amount of security that they could ask from the entrepreneur. I believe historically it used to be 25%. We're going back probably about 5 years in this. And the banks could not ask for more than that security. Which was really nice if you're a business owner, because you're not putting your house on the line, you're not putting any savings on the line by getting this loan. But now, with the rule changes a few years back, the banks can ask for basically a personal guarantee on the entire amount. So there's still, the entrepreneur is really only going to do this on something that they think is going to pay back. So although the federal government is backing it, you're still listed as a guarantor. So it's, the bank's discretion if they're going to go after you, or they're going to go to the federal government, or a little bit of both. So it's no longer a no risk or limited risk product. You could be on the hook for the entire thing. So that's an important distinguishing item about that loan that didn't used to be. So, but it is there now.
What are the benefits of doing a business plan before applying for a loan?
So again, because you're taking the risk on this loan as an entrepreneur, we want to have a business plan in place to make sure that we can pay it back. And the other, secondary item, I guess more like 1A and 1A, is you want to actually qualify for the loan.
Yeah.
So doing a business plan before is actually going to increase your chances of qualifying for this loan. We're big proponents of getting professional help on business plans, because it's good to have more than the business owner's eyes look on business plans. You want as many people to poke holes in the business plan as possible. That's the benefit, as well as the cash flow components of any business plan. They're a bit of a struggle too. So getting a formal business plan in place is, first of all, going to give you the most opportunity to actually qualify for the business loan. So you don't want to get the no and then try to have to go back afterwards, because that can be a bit of an uphill battle. You want to be at, yes, or at least maybe But you don't want to be a hard no on your application and then try to go back through the system again, because like I said, it's not every bank who's going to want to do these deals, so you don't want to you don't want to get thrown in that no pile already. So the first thing is do a business plan so it increases your chances to actually get the loan. And the second thing is to make sure that you're actually going to be able to pay this thing back. So it's not uncommon. We get business owners who come in and they have qualified for this, but they didn't really have a realistic plan to actually make the loan payments. The banker who said yes, we have to realize that who these bankers are going through. They're going through small business bankers a lot of time. So these are not, a lot of times these aren't bankers with 20 years experience. These are bankers who've been on the job for, less than 5 years, or often, less than 2 years at the small business end, because the small business banker tends to be a stepping stone position. They go from, a small business banker, and if they're good, they get promoted, and if they're bad, they get fired. But no one really usually stays as a small business banker. That's just the way they have their HR strategy. So just because you qualify doesn't mean you're going to be able to pay it back. And is that business strategy solid? That's the business plan that you want to have in place. So can I increase my chances of qualifying and increase my chance of having a business that's going to successfully pay this back? That's why you do your business plan before you qualify for these loans. So I think that's all the time we have here today. Feel free to leave a comment and hit the subscribe button for future videos. Thanks very much.
Thanks.